Does gold outperform during recessions?
So I want to check out this piece from Visual Capitalists, how gold performs during recessions. Does gold's value increase during recessions? Gold has been traditionally considered a safe haven asset, with many investors turning to the yellow metal during recessions and times of turmoil. So how does gold hold up when the economy tumbles? Well, we can see from this chart, which highlights gold's price movements during recessions and compares it to changes in the S&P 500. Gold's value comes from its scarcity as a precious metal, in addition to its long history as a stable medium of exchange. Gold also has a low to negative correlation with the stock market, suggesting that changes in the price of gold are largely independent of how stocks are faring. As a result, gold is considered an effective diversification tool for investors who want to hedge their bets. But has gold helped investors weather recessionary storms in the past? Well, when we look at this, you can have a look at 73. So I talk about that quite a bit, 73, 74. So in that 73 recession, S&P 500 fell 13.1%, gold up 87%. Then 1980, 81, gold really got smoked in comparison to the S&P 500, and as well as the 1990 recession. It wasn't until 2001 and then 2007, 2008, and even the 2020 recession that gold outperformed. So since 1971, when the gold standard was abandoned, gold has largely seen positive price changes during recessions. And in the last three recessions since 2000, its performance has countered that of the S&P 500. While the increases in value haven't been dramatic, they help cement gold's position as a hedge against financial turmoil and as a store of value. For example, when the stock market collapsed in 2007, investment demand for gold increased as investors looked for a safer option. Between 2007 and 2011, gold's price more than doubled. Similarly, with fear and uncertainty at a high during the, gold-backed exchange-traded funds saw record inflows and the price of gold reached an all-time high. So that was in 2020 after that first initial fall, which we'll come to in a second. However, while gold's price tends to rise during times of economic turmoil, it often stagnates or falls when the economy is healthy and investors seek riskier investments. As a result, it's important for investors to consider the overall macroeconomic and geopolitical environment when looking at gold. Well, that's what I've been looking recently. So is gold's time to shine in 2022? The global economy has been shaking with turbulence in 2022, with consumers facing high inflation and investors seeing dismal stock market returns. While these market conditions typically point towards rising demand for gold, that hasn't been the case so far this year, with prices down 2% year to date. This is partly because of rising interest rates, which increase the opportunity cost of holding gold as investors forego the interest income they could earn from saving accounts or bonds. But in fact, history shows that gold often outperforms US stocks and the dollar following interest rate hikes. So let me read that again. History shows that gold often outperforms US stocks and the dollar following interest rate hikes, after underperforming in the lead up to the rate hikes. Sound familiar? Additionally, high inflation is eroding the purchasing power of each dollar, incentivizing investment in a tangible asset like gold and other hard assets. With geopolitical uncertainty at a high and the US consumer sentiment at decade lows, will gold prove its value as a safe haven in 2022? So what I want to do now is cut to a short couple of minute clip with George Milling-Stanley, who's from State Street. And pay attention. So it's from late 2020, this short little clip. But pay attention to what he has to say about gold's performance versus other asset classes in recessions, and in particular his comparison with other recessions and market sell-offs, where he mentions that the stocks usually sell off and take quite a while to recover, where gold tends to run. However, in 2020, stocks actually recovered very, very quickly.
I want to go straight to a chart from a recent blog post he had. I think it's super interesting. It's called Gold Fights Back During All Phases of a Cycle, Even Recovery. And it shows, as we look at different asset classes, gold, equities, treasuries, and the dollar, how these have performed according to your team's calculus during these different types of economic environments. Generally, recession is the one in which gold has done the best on an average monthly return basis. But what's interesting, George, right now is gold seemed to be, as you point out, linked with stocks in our recovery, which is weird because technically we're in recessionary conditions, but many argue that we had a cycle that started up in March. And the economic recovery on a relative basis has been strong and definitely recovered since the worst. So what are we to make of gold? Is gold a reflationary and recovery play right now, or is it like an apocalypse play?
I think I'm not sure what to choose between those two. I'm not sure I like either one of them. What I would say is that markets are very, very weird right now. We're living in very strange conditions with the pandemic. It's very, very hard to see exactly what's going on. We had this strange move in equities. You know, in March of this year, when equities sold off dramatically, it reminded me of the global financial crisis of 2008, the recession of 2002, and Black Monday of 1987. On every one of those occasions, the equities sold off dramatically. Gold sold off briefly as people used it to meet their liquidity needs, but gold recovered very quickly. On all of those previous three historical occasions, 1987, 2002, 2008, equities took a long time to recover. Now, equities broke the mold. They broke the pattern. It's not gold that broke the pattern. Equities broke the pattern in March. They had exactly the same kind of V-shaped trajectory that gold did. And frankly, I'm a little suspicious at the speed of that recovery. I think it was people's perception that the Fed and Treasury were going to come to the aid of the economy, although I think, frankly, most of the aid actually redounded to the stock market. They bailed out the stock market rather than the underlying economy. Yes, we've had some good economic numbers, but I think that we are still in recession. And I think that given the fact that in many aspects of life, whether it's factories or offices or colleges or high schools, we're having to close down, having reopened a little too early in this country, I'm afraid that we might be in recession for quite a long time. And if all of these second wave of infections of COVID coincide with a bad flu season, which is a possibility, then things could stay bad for a long time. This is why I'm not seeing gold prices depressed for much longer. I think that a rebound is very much on the cards on the historical evidence.
So let's have a look at some of these asset classes that George was talking about and these different time periods of these market sell-offs. And here we've got the stock market, US 10-year bonds and 3-month treasuries, as well as gold. Now, this isn't a peak to trough because that 73-74 recession that I always talk about, the stock market actually fell close to 50% in nominal terms. So this isn't a peak to trough. So, yeah, these are just during these time periods. And you can see that, especially compared to the stock market, gold has performed quite well. However, you will notice in the tech wreck, the .com bubble bursting between 2000 and 2002, stock market fell, gold did well, but there's a lot of people out there arguing for the 10-year US bonds, and they performed 21%. And also during the GFC, another 21%. And so a lot of people are saying, well, you know, right now you want to hold bonds, not gold, and definitely not stocks, and definitely not cryptos. However, I argue, and here's a chart of the federal funds rate, I argue that, yeah, it made sense because, prior to the dot-com bubble bursting, we had the federal funds rate at 6.5%. And so the Fed had a lot of room to cut. Okay, and so interest rates came down, bond prices went up. So that was a no-brainer. And then just before the GFC, the federal funds rate was around 5.25%, so 5.25%. Once again, the Fed, central banks around the world had room to cut. So as yields fall, as bond prices go up, and so that did make some sense to have bonds as part of your portfolio at that point. Plus, you got the yield at that period of time. Now, with yields so low, now some people argue because yields have gone up from basically almost zero, that now's the time to jump into bonds because the Fed will be reversing course soon, cutting and going back down, so you'll make some on the bonds there. Well, I'll argue that if they reverse course very soon, then that's a sign that, you know what, the whole financial system, this whole fiat currency system, is not worth very much. And you want to be getting out of all types of fiat and all types of paper currency, if you will. And you want hard, tangible assets like gold, like silver, etc. But in my opinion, central banks are going to continue to raise because of the politics. Okay, the politics are different now. We also didn't have the big CPI problems like we do now back in 2001, 2002, 2007, 2008. Yeah, CPI did start to get up, but it never became the problem that it is right now. So I see interest rates going up more, which is going to create a recession. I believe we're already in a recession. Stocks will underperform. In fact, I think indexes, the overall indexes are going to perform very badly for the rest of this decade. So, you need to be very wise in picking individual stocks. And they just don't have the room to move the way they did back then. So I don't think bonds are going to be the big asset. In fact, I think central banks are going to continue raising, which means if you buy bonds now, well, you're going to lose. And so if we have a look at just comparing the S&P 500 gold and silver, but go right down the bottom, so that February 19th, 2020 to March 23, 2020, where the S&P 500 went down to 34%, gold down 5%, and silver down 32%. However, we know then, so gold in particular, briefly sold off because, liquidity of, people trying to get access to dollars. And we're seeing that. So we're seeing the US dollar going up. So that's the demand for dollars. So when people need dollars, they need to sell other assets. So sold gold, sold silver to get those dollars. We're seeing that now. Gold and silver have been selling off. The US dollar has been rising. There is a global demand for dollars. Like it or not, Brent Johnson's dollar milkshake theory makes sense. I've argued that it makes sense to me. That's why I hold a portion of my portfolio in US dollars. It's a trade, though. I'm not going to hold. It's not because I love US dollars. You guys know me. I'm the real gold and silver is real money. So we're seeing gold and silver sell off right now. The difference, and as George said back in 2020, stocks came flying back. They recovered very, very quickly. This time, I don't think they will. Gold and silver sold off in March 2020 and then went on a big run. Silver hit $30, gold all-time highs. Now the question is, I believe that we are in recession. Earnings are going to be horrible moving forward. Input costs for businesses are going up. That's going to impact earnings as well. I don't like the stock market. I don't like the overall index. All these stocks that were pumped up at, 50 times sales. Oh my goodness. Huge PEs. Tina's dead. If interest rates continue going up and all of a sudden you can get maybe 4 or 5% on a bond, well, you might find that retirees start reducing their risk, putting some more of their capital in bonds, even though they are still losing on inflation adjusted basis. And maybe they go into some gold as well, not for the yield, but for that inflation hedge. So does gold and silver go on a run from here? While stocks don't perform, so similar to 2020, where gold and silver went on a run. However, all of a sudden, everyone poured back into stocks, and stocks outperformed, recovered, and just turned itself into a almighty bubble, where I just saw so much FOMO going on. That, and then that led into real estate, etc., etc. This time, I think real estate's going to get hit hard. I think bonds are still going to get hit hard. Stocks are going to get hit hard. I think gold and silver have already been hit hard. Could they fall a little bit more? Absolutely, they could. But I do see dark times coming. There's a lot of geopolitical problems around the world. I think gold and silver could well be about to go on a run similar to all those other times during recessions. Anyway, what do you guys think? Love to see your thoughts and opinions in the comments below. Once again, if you like this video, guys, please hit that like button. Really, really do appreciate it. Take care, everyone. I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor, having regard to your own objectives, financial situation, and needs.